Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall, and here with me today is Alan Porter, Manager of the Securities Trust of Scotland. Hello, Alan.
Hello, Emma. How are you?
I'm very well, thank you.
Good.
So the Trust used to be purely income from UK stocks, but now it's global. And in particular, there's a large allocation to the US, which I think will surprise a lot of investors because we've got a healthy dividend here, but people still think of the US as a country that does buybacks rather than pays out dividends. No longer the case, perhaps.
Well, I think it's absolutely true what you say that US companies, when they're thinking of returning money to shareholders, do split it between the dividend and share buybacks, and they're much more into share buybacks than companies around the rest of the world. But don't forget, the US is the biggest economy. We have a truly global benchmark. I think one of the few global growth and income funds that do. And the US still manages to make up a decent 40–45% of that, and that's why we have that kind of exposure, and we are marginally overweight the US at the moment.
You've talked a little bit there about how massive the US is, how many fantastic opportunities there are. When you're looking for equity opportunity, is there a benchmark in your head where you're thinking, if they're not paying at least a 3% yield, I'm not looking, and they're not going to be included in the trust, or is it much more about dividend growth?
Well, actually, it's a combination of the two. One thing we've always been really clear about is the objective that we have for Securities Trust of Scotland, and that is quite simply to offer shareholders both an attractive and rising income, or dividend if you like, as well as the potential for long-term capital growth. And for me, I kind of read through that capital growth as being effectively dividend growth. Dividend growth is a great proxy for cash flow growth, and that in itself is a great proxy for capital return in shares. So really, we're after that combination of both. We've never run a barbell strategy, going for some really high-yielding stocks that don't grow at all, or for some really low-yielding stocks that maybe have a lot of growth. Quite simply because our fundamental philosophy is that companies that offer that combination of an attractive dividend yield and attractive potential dividend growth, as well as relatively stable cash flows, outperform over time.
And you also have quite a high allocation to Europe, and I think talking about the sort of companies that you're looking for just then, it may surprise people that there are companies that are in rude health in Europe who meet those criteria.
Yeah, well, the three things we look for when we are looking at companies are, number one, an income margin of safety, so plenty of cash flow cover of that dividend so that we've got optionality for that dividend to grow going forward. Secondly, an attractive valuation margin of safety. We don't want to be paying up for the stocks that we own. And then thirdly, some sort of insight that we might have that might make us believe that the market will look at any individual company more positively. And really, the geographic makeup of the fund really comes out of looking for those three things from a sort of bottom-up approach. And what I would say about Europe in particular at the moment, and don't forget this, is that QE is a relatively new phenomenon for Europe. And what we found when we had QE in the States, when we had it effectively in the UK, when we had it in Japan, that for the following 6 or 9 months after it started in each of those regions or countries, shares there performed really well. And that's partly why we're sort of positioned with an overweight position in Europe, as well as actually just finding some attractive opportunities.
And does that mean, as QE is obviously wound down in the US, that you're going to be taking money out of there and redistributing it into those places that do have that kind of uplift? Well,
that's a really good point. Our US weighting is probably lower than it's been for a number of years because of that, but also because it's been, and linked to QE as well, it's been the strongest market in sterling terms over the last few years. So that valuation margin of safety that I mentioned is more difficult to come by. But you cannot get away from the fact that the whole entrepreneurial sort of ethos in the United States means that there's just plenty of opportunities almost at all times of attractive looking companies to invest in. But no, that's the reason why at the moment our US weighting is relatively low compared to where it's been over the last few years, and our European weighting is relatively high compared to where it has been over the last few years.
Alan, thank you very much.
You're welcome.
This is Emma Wall from Morningstar. Thank you for watching.